Let's start. This is not the Terminator or anything. I'm Marco Meyer from fxatm.com. I'm the author of Forex at the Market, the advisory. I've been a student of Joe Ross, who invented the law of charts for many years, and learned most what I learned about trading from him. Maybe I can say that later at the end, okay? But I like the I'll be back better, so maybe I should go with that one. Okay, today's topic is KISS trading, which is for keep it simple, whatever trading. Will be about the law of charts, but just gonna cover the basics today, and then we're gonna do a little discussion, and then go to some live examples. So here's the more detailed schedule. I've already done extended webinars about the law of charts in the past, so this will be a kind of brief version of it so that we have more time for question and answers and live charts today. For those of you who don't know about the law of charts, can go to the recorded sessions at FX Street and watch the more detailed version of what I'm going to present today. We also look at some examples from recent trades that we did in fxatm. And if you have any suggestions for the next webinar, what topic would be interesting, then you can tell me about that at the end. Okay, so let's start with this one. This is kind of an exaggeration, kind of overdone. I found that somewhere on the web, I think a couple of months ago, or even, I don't know, euro was at 43, it was probably a couple of months ago, just as an example of what some people's charts look like, and then they kind of try to make a decision about what to do here. So for me, that's very unclear, and when I started out trading, my charts didn't exactly look like that, but I also had quite a lot of stuff on them, at least 3 or 4 indicators, moving averages, some Fibonacci lines, some trend lines, maybe a trend channel, Bollinger Bands, whatever, that kind of stuff. So they don't look that extreme, but kind of like that. And yeah, it was about the chart with indicators and the other price. And yeah, that changed significantly when I started to learn about the law of charts from Joe Ross, as you're gonna see in a minute. If your chart looks like that, you've got the couple of issues, and what the reason for myself when my charts looked like that thing that was crowded with indicators and things like that, when I really asked myself why that is so, I came out with the conclusion that the reason why I did that was that I tried to filter out bad trades, for example, and try to put in so many things to kind of create a confluence or whatever, confirmation of an idea I had, because I just didn't want to lose. So I couldn't deal with having losing trades, and that's why I put on more and more stuff trying to avoid this. But at the end, it's really kind of just an illusion that you create that way, since the issue itself that you can't deal with losing trades doesn't go away by putting a lot of stuff on it. Instead, you just have to learn to deal with that and stop blaming your charts, indicators, or your system or whatever if things go wrong for a while. What's important to understand too is that there's actually no indicator that can show you anything that price doesn't show you, or price and volume. If you have volume, usually you don't have that in Forex, but if you trade futures, you have volume too, because all indicators are based on that kind of information: time, price, open, high, low, close. and volume. So you don't see anything special. So now what about that? That's what my charts look like now. Actually, I don't even draw in that formation, but that's what it looks now. So that was quite a change for myself, a transition to go from the crowded charts to something simple like that. And yeah, I actually learned to trade without any of that stuff, just looking at price charts. And I do so mostly by using the law of charts, what we're going to talk about today. So yeah, let's just start. But I think it's quite clear what I'm going for here. I personally believe that if you keep your trading simple, like what you've just seen, then you can actually start to focus on what's really important in trading and no longer focus on stuff that's not important, like filtering out trades and trying to get your entries perfect. And instead focus on what you can control and where you have a real chance to improve your trading results. And that's things like risk and money management, position sizing, of course. Then the most important one, managing yourself, because if you kind of like screw up in that one, then nothing's going to help you. Then managing a trade once you're in. That's, in my opinion, the real art of trading. Not to get the entry perfect, but to do everything right once you're in a trade. And then learn to trade in a consistent way, learn to trade consistently, have a trading diary, for example, where you write down what happened on a specific day, what you did wrong, what you did right, what could have been improved, and to have a record of your trades and how they went, print out charts and things like that. And then you can actually, after a while, go back and see what could you have done differently or really improve things instead of just switching from indicator A to B to C and staying in that circle. So now we're going to have a brief review of the law of charts, which is not a method or a system in itself. It's actually more of a precept, a fact of what you see on the charts. And there are many ways to actually use that law to trade in a specific way. So we're going to start today with 1 to 3 formations and the Rossock, two quite popular formations. Maybe you heard about them already. There's quite some information on the web that you can find. So 1 to 3 formations, that's actually the most simple formation that you can have. You've got a leg down, which is the market moving down for a while. Then you get a leg up, grading point 1. Get another leg down, grading point 2. And now the important thing is that this low here doesn't go any lower than that one, and instead you get another leg up, which is a 1 to 3 low, completed one. So that's the most basic formation. And I think most of you know that in some way, but probably didn't figure out how to actually trade it and trade it in a consistent way. And what you get after 1 to 3 low, when you get another correction, is like a Rossock. So after that one, when price breaks through point 2 and then you get another leg down, you have a Rossock in place. So Rossock is essentially the same as a point 2, just after 1 to 3 formation. And a point 1 usually then, of course, is potentially a Rossock. There's a question, how many bars you have to be in each leg in 60-minute chart. All that depends. We're going to talk about that in a couple of slides. So just wait for those. And if the question is still not clear at the end, just remember me and ask again. But we'll come to that in a few minutes. Basically, it's one bar is enough. That looks like bearish butterfly from harmonics before the Rossock. Okay. I don't know the bearish butterfly or the harmonics, so can't say. Maybe. I don't know. So here's an example for 1 to 3 low on a bar chart. which actually just consists of 3 bars. So we've got point 1 here, price moves down here, creates point 1, then point 2 gets put in here, then you get point 3, the low doesn't go lower than point 1, and price moves up. So here we've got a complete 1 to 3 low. And of course 1 to 3 high just looks like the same, just the other way around, turned upside down. So here we got an up move, point 1 is created, price moves down to point 2, moves up to point 3, but doesn't go higher than point 1. That's always the important thing. And then here we would have the formation completed. And the Ross hook, as I said, is just when price after 1 to 3 high or low and price continues and then corrects again, then you actually get what is called a Ross hook. So when price is starting a correction, meaning you've got a higher low here on that price bar, then the Ross hook would be in place. So it's said in one sentence, the first failure of price to continue in the direction they were moving after strong breakout. It doesn't have to be a 1 to 3 high, for example, to create a Ross hook. You could also have a breakout of the trading zone, for example, of a sideways market, or another strong move. It doesn't really matter. What's important is that you get that kind of correction, and then you can look for a trade there. So here's another example. Here we got what is called a latch. Price moves sideways for a couple of bars, strong breakout, and each of them higher high, and on that stops. And when that had the bars, the Ross hook is actually in place up here. So what happens here is that the Ross hook itself never gets triggered. Instead, price continues to move lower. Then we get a correction up here, creating point 2. Then after that price starts to move down again, creating point 3. And then we've got a 1 to 3 high in effect. And after that, again, same thing. You get lower lows all the time. Up to that bar, that's the last one. On the next bar, you get the correction, and the Ross hook is in place to the downside. So that's really the most basic concept of the law of charts, and that's what I use mostly to find trades in the markets. So now we've defined some patterns that make up the law of charts, and what makes this formation unique is that they can be very precisely defined. So in other words, if you're trading other patterns like, I don't know, heads and shoulders, coils, flags, pennants, megaphones, whatever there is, or I don't know what kind of stuff's out there. Those often cannot be defined in a very precise way. They are more like very subjective often. Sometimes you see somewhere resistance, sometimes you don't. You can draw in a trend line in 5 different ways quite often, depending. You can use the lower lows, the higher lows, and so on. But using the law of charts, you really have some clearly defined patterns, and that actually makes it possible to trade in a consistent way, which is very important, because what you're going to do is take the same trade again and again. If you get the same price chart that you have, for example, now, if you would get the same price chart again tomorrow, you would do the same trade. And that's really important if you want to become a consistent trader, because otherwise there's no way you're gonna reach that goal. The law of charts works on any time frame in any market, as long as you get clear formations on the charts and the market is moving nicely. So you don't want to do this on a 1-minute chart in the Euro, Swiss franc, in the Japanese session, for example, in the Asian session, because there will not be any movement, there will not be clear chart patterns, things like that. But you would be fine to do that on a daily chart, for example. Or then you can also trade a 10-second chart in the Euro-US dollar if you're doing that at the US market open. And when the market is fast, some data's coming out maybe, then you're going to get clear chart formations there. So that's what you have to look for. But besides that, you can use the law of charts in really any time frame or market. And one of the big advantages of the law of chart is that you always kind of like you're forced to trade with the flow of the market. So you don't get an entry that goes completely against the ongoing trend, for example. And when the trend is finished, you usually get a 1 to 3 high or low where you can jump in. What time frame do you prefer? I usually use daily charts, but sometimes go lower to 4-hour or hourly charts to kind of like fine tune the entry. But most of my entries happen on daily charts. So now we're going to look at the trader's trick entry, which is one way to actually put the law of charts into action to trade using the law of charts by having specific entries. And here's an example of that. What we have here is a 1 to 3 low, high, 0.1 here, 0.2 here, then we get 0.3. And so the 1 to 3 highs in place. And the usual way to trade this, for example, would be to trade a breakout of 0.2, right? So it goes short down here. Now, using the trader's trick entry, it simply allows you to get in earlier at this point at the violation of this correction bar. And we're going to look at that concept in detail now. So, as I just said, the purpose is simply to get us in before everyone else does, which gives us an edge over other traders. And that is very important in trading, because if you're the last one buying or selling, then you'll be the one who doesn't get anything out of it. So you have to make sure you're kind of like, I prefer to be somewhere in the middle of, if you have a queue of traders, some try to get the entry very specific, very perfect, and try to be the first one who sells, for example, try to guess where the top is. And then there are traders who come in quite late, trading moving average crosses, for example. And I try to be somewhere in the middle, like where you get a direction of the market already, and you get a hint that it kind of starts moving again, and then I try to jump in just on the flow that's just about to start. Okay. That is history. Do you still do that on live? Jim, do you mean by that if I'm going to do that on live charts today, or if I'm doing it at all? I'm not sure if I get the question. What I'm showing now is just to get the concept over to you. So this is true, these are old charts, but kind of like to get the concept over to you, the best thing to do it is using slides that are prepared, because if I just go into charts where nothing's written on, then it's quite hard to explain it, right? So it's easiest that way, but I'm sure we're going to have time later on to jump into some live markets here. So the purpose is to get in before 0.2 or Ross hook. If we get a real breakout, like here, for example, we have quite some nice profits. If the breakout is false, we usually will have the costs covered and maybe have a little profit. So here's how it actually works. Once 0.2 is in place, what we would try to do is just to get in at a violation of the high of each bar here in the example of a 1 to 3 low. And we try them one at a time. So you try here, here, and here. Yeah, here it is. And then try here last to get in. So, for example, if that bar is completed, we try to put a stop buy order above that one. Doesn't get triggered on the next day. Instead, the correction deepens. We do the same thing again. And here's the last one. We try, put in the order again, and maybe we get filled and the market moves up. So if you go back to that example, on that price bar would have been triggered on that one. Price moves up nicely above 0.2, and Ross hook is created. And here we would do the same thing again. We could try here, here, and here, just above the highs, placing our orders and see if we get triggered. And on some days you get triggered on the very first bar, on other days on the second or on the third. But you don't want to do more than 3 or 4 correction bars, because otherwise the momentum usually is kind of lasts Okay, is that clear so far? So instead of getting in, for example, at a breakout of the Ross hook, you'd simply try to get in on the correction bar. Okay, now we're gonna show you some recent trades that we did in forex at the market. Those are quite hard to beat when it comes to keeping it simple. So let's just have a look. First one was in the New Zealand dollar. That was somewhere at the end of April, I think. And the idea was, as you can see, we had this nice uptrend here going on the daily chart. Then we got that correction bar that put in the Ross hook up here. And once that correction bar was finished, we had a possible trade a strict entry and try to buy one tick above the high at the blue line, as you can see. That has been the entry. Stop loss down here at the red line. First profit target up there, second profit target just slightly above the Ross hook. And this is how the trade works out, kind of a little bit zoomed up. We got triggered long on the very next day. First profit target was hit. When that happened, I moved the stop loss, I think close to break even at least. Day later, second target was hit at 80.14. Kept on moving up the stop loss to the lows and finally was stopped out on that day at 79.82, so somewhere about here. Yeah, that's quite a classic trade. Very simple one. Didn't need any indicators to figure that one out. Next one was pound Swissy. Next example, which was a short trade. Quite similar setup, as you can see. Most of my trades look the same, so quite boring if you think about it that way. We had a good example of a sideways market, very short days. Nothing happened. Then price broke out and moved down strongly for a couple of days. Then we got that big correction, price moving up there, creating a Ross hook down here. And what I liked about that one is that over here we had another Ross hook, right? So we had two Ross hooks where price could break through, and usually when price breaks through Ross hook, what you get is some momentum out of that because traders get stopped out or get in at those breakouts, so you kind of have that momentum on your side, which is always a good thing to have. So on that example, the idea was simply to short a tick below that correction bar, stop loss up here at the red line, profit targets here, and I always usually trade at least in three lots. About one third at the first target, another third of the position I close at the second target, and the rest of the position I just keep on for a possible runner. And what we had here, what happened was that on this day, as you can see, orders got triggered and we got short. Then on the next day, price corrected quite strongly, but I didn't get stopped out. Price moved lower again, and on that strong move down, the second target was hit, and of course I kept on moving down the stop loss. And when price was trading at 42, I decided to just take more profits because it was quite a nice move in a couple of days, and odds were high that we would see some kind of correction. So I took some profits there and finally got stopped out at 42.72, which is quite another classic trade. So if you want to see more of those, you can go to fxatm.com and sign up for free issues at the bottom of the page if you're interested in that. Yep. Any questions? If not, we can just go to some live charts. If there are no questions to the slide so far. Okay. Okay, so you should see the US dollar Swiss franc now. Can you see the chart? I don't know what you prefer. That bar chart is fine for you, or if you would like me to use candlestick charts. I don't care. Basically, they show the same, so Um, I usually prefer bar charts, but candles better. Okay, so candles would be great. Okay, good. So here we go. I hope the colors are fine. It's white and red. So we should see clearly when we have a down or an up day. Okay, good. So is there any market on a specific time frame? Yo said the euro dollar would be interesting, so you can just go to that. Okay, so I usually go to start on a weekly chart and then go lower from there. Okay, 1 hour chart. Okay, let me see if that's up to date. Okay, good. So what we have on a 1 hour chart now. Yeah, I'm gonna start like this, because the most important thing always is to just get an idea what's going on in the big picture, right? And then go down to, for example, a 1 hour chart and look for a trade. That's how it works. It's not like the setup is not that important. What is important is where we are. And now if you look at that and would look for a day trade, for example, you'd clearly see that we have that big 1 to 3 high here. Price broke through that. And it's kind of doing a correction of that down move now. So that's what's happening here. And now we can kind of like go into this and see what's happening there. And what we had today, for example, was 1 to 3 low down here. Let's see if that works. Okay. So here we had a 0.1, 0.2 up here, then 0.3. Price broke through on that bar, probably on some news, I guess. From there on, prices moved higher and actually took out the high of that last swing high, right, which is quite something important to notice. I personally wouldn't be too excited to jump in for a long trade here, and instead would probably look for some kind of a short setup, which right now we don't get on a 60-minute chart, definitely. So let's see on a 15-minute chart, that looks a lot better. And here we would have a potential 1 to 3 high, just kind of like building up. But this still has kind of like get finished. Although the time right now is not the best to do a day trade in the euro, because the US traders are at lunch now and those from European are already at home. So there's not a lot going on right now here. And yeah, simply because out of the time we are in now, I wouldn't be too excited to get into any trade, because the odds are high that you just see something like, I don't know, some kind of sideways market, probably trapped, I'd say between those two lines for the next 1 or 2 hours. And then when everyone's back from lunch in the US, we might get some more moves. But right now, the market is just too slow to look for a day trade for me. Yeah, but basically that's kind of like what I do when I day trade. I don't do a lot of day trades lately. I've done more of those last year. I'm really kind of focused on daily charts right now, because it's getting summer here and I don't want to spend too much time on the screen. Yeah, basically just for the sake of an explanation, what we have here is the Ross hook up there, right? I do 1 to 3 low here, Ross hook here, and here's the next one. And technically this is a traded strict entry. So one way to take a trade would be, for example, to get in if that high gets broken at 42.39, stop loss down here. But as I said, I wouldn't take it just because of what's going on in the markets right now. But yeah, just as an example, let's see how that one would turn out. as I said, this is not a recommendation or anything at all. It's just for as an example. And yeah, what you usually get around lunchtime is a lot of, you get traded entries triggered or signals triggered, and then it kind of moves slowly up and down, but you don't get really strong moves like this usually. Of course, you never know, but that's my experience. And you always, when you're day trading, what you really need is momentum going on, right? If you trade like here in the middle of the night somewhere, you usually don't get good trades because there's just no one there to actually move the market. And also the spreads tend to be higher, or you get more slippage trading futures. And yeah, it's really a mess to do that. So the best time usually to trade, for example, the euro is at the London Open in the morning for about 2 or 3 hours until lunchtime in the Eurozone. And from there I would wait, if there are news, at least till 8:30 US time, or then when the US markets open, when the stock markets open during the next 2 hours. That's usually a good time to do day trades in the euro US dollar. And then again about two hours where nothing happens, and then during the last 2 hours of the US stock market, that's the second time of the day where you can get some nice moves. What happens there often is that you get some kind of reversal when everyone's back from lunch. Yeah, as you can see, that one doesn't look too bad now, right? But it's just moving slowly, and my guess is that it'll just come back and stay in that range somehow. Okay, how to have tight stop loss if you trade from signals from daily, please advise. Well, there are different ways to do that. Let me just show you some example. Gonna leave that open. We can go back there later on. Let's go to daily chart. I don't know. Let's just take that Ross hook here. So up there we got a Ross hook created by the correction of that bar with a lower high, and we could try to get in using traders to entry on that bar. Didn't happen on that bar. Did happen, and then put in one on that bar, and we got triggered here. The classical way would be to put the stop loss down here at the swing low or at the low of that price bar. Now the question is how to kind of like tighten up the stop loss to have a smaller stop loss. And to do that, I usually go down to 60-minute chart and then look for a swing high or low there. So as you can see, this would be the high of the traded strict entry where we put in our order. Yep, that's it. And we would be triggered on that bar. So one way to do it is just to use kind of like the swing highs and lows you get here, right? So one way to do it is to use the swing lows and highs to put in the stop. But to do that, you of course have to be in front of the screen somehow, because otherwise you won't know where that was during the last 5, 6, whatever hours. But if you can manage that, then you can just look for your entries on a daily chart like here, and then put in your stop at the last swing low, which would be here, and give you a very tight stop of about, I don't know, about 20, 25 pips. If you can't manage that, another way to do it is kind of like use some value like the current volatility that you get from the average true range, for example, and use half the daily average true range, and then after the entry look into further tighten up the stop loss. Of course, when you do something like that and use tight stop, that always also has disadvantages, because quite often you could get stopped out simply because something happens, like you get triggered in up here and price moves down, does a correction like that, and then starts moving higher again. So you can, of course, get kicked out of a nice trade too early. And if you trade like that, it's important that you always look to get back in again after you got stopped out when you see price is actually moving higher again. So, for example, if you get stopped out here and you get a 1 to 3 low intraday somewhere, you could just get in at the high again and look for the move to continue. Good, so let's go back. Yeah, as I said, also high that's coming back. And what we have now is a 1 to 3 high developing, meaning we could try to go short on that level with a stop loss up here. But again, during that time, as you can see, that's kind of like just noise. What's happening now? It's really random movement, and yeah, there's no point to get in the trade on that time frame now for me. How can you time your trades perfectly? Well, you can do things to improve your timing, but at the end, there's no way to trade them like perfectly. Sometimes you're just lucky and get in at perfectly the right time. Most of the time you don't, and you have to somehow find ways to deal with that you don't get it right. That's what happens most of the time. At least for me, most of the trades I get in, they don't kind of like have the perfect timing, but need some time to develop during the day. Especially if you're trading breakouts, that's what happens a lot of the time, is that you just get some kind of a pullback, and then price continues in your direction, and it doesn't happen too often that price just kind of like blows through the level and keeps on running for hours. That's not what happens most of the time. Yeah. What you can do, as I said, is if you're day trading, for example, look for the right time to trade. Don't trade when there's nothing going on. Look at the big picture. Definitely the most important thing, to see where you are in the overall picture of a market. Don't kind of like go down to a 5-minute chart and say, oh wow, we've got a 1 to 3 low here, let's trade that, without looking at what's going on around, because that's just not going to work over the long term. It's always more important to see where you are in at the bigger picture, and then look for a setup in the direction you actually want to trade, and a direction that hopefully makes sense. So in other words, don't trade against the larger trend. So for example, if you have this here, which is definitely an uptrend on a 5-minute chart, and you get a 1 to 3 high on a 1-minute chart, and I'm sure we're going to have that somewhere. For example, here, that's not a trade you want to take, and instead you want to trade with the higher time frame trend of a 5-minute chart, for example. So that's an important concept to understand, because where you can make most of the money is always going with the trend and trading in the direction of it, because that's where you get the most clear and easy moves. And that's important, because otherwise you cannot manage the trade correctly. If you get a lot of noise, and that's what you usually get if you go against the trend, then it's very hard to move your stop loss without getting stopped out too early from a trade, for example. Yes, correct. The deeper pullback on a 1-hour chart may stop you out sometimes. There's always the thing, you cannot, if you take great risk-reward trades, right, with very tight stops where you might get 5 times the initial risk, at the same time you have usually about 5 times higher risk of getting stopped out. So that's always something you have to deal with. If you cannot have kind of both. You cannot have a perfect risk-reward ratio and at the same time have a high winning ratio. That's not possible. And that's just logical, because that's, when you do that, you're just more into the noise that's going on in the market. And if you just say, okay, I don't care, I trade on a weekly chart, and then you avoid everything of what's going on intraday, and but your risk-reward ratio will not be that great usually. For the trader strategy, we have for the candle to close a few pips over the last bar high low. Well, for example, here you have to get the correction bar has to close usually. What I tend to do, since I'm trading daily charts, for example, and daily close at 0 GMT is not the perfect time for me because it's somewhere in the middle of the night. When I see a nice setup on the daily chart and price is trading, I don't know, 50 pips lower, and it's going to close the daily bar is going to close in 2 hours, then I'll not care and wait for it and stay up, but that just breaks my order and go to sleep, because usually you don't get a lot of action at that time anyway, and if it happens, it won't be too significant. So that's what you can do. But usually on an intraday chart, for example, I would wait for it to close if you can. Okay, and really something to look for also is those nice weekly or monthly charts. You can make some really nice money with those. It's really easy trading and you don't have to spend a lot of time. If you look at that, that's really very nice, clear chart. You don't get a lot of false signals, and the moves you get are always very significant, and you don't have to spend a lot of time. If you take a look at those once a week, you're already fine, right? Or if you want more action, go to a weekly chart. Same thing, very nice, clear setups. If you look every couple of days what's going on in the market you're trading, you're fine. Or go to daily charts and trade just by the close. For example, you can do that using a line chart, which is probably the most simple thing. So you could, for example, just if you have got like this 1, 2, 3 low down here, just get in and then trail that trade on the swing highs and lows. Get stopped out here, wait for the next one, get in again, and yeah, it's very, very simple, and it works, right? Okay, so let's go back to our intraday action. Yeah, as I said, it's probably not going to move a lot now, and everyone who's trying to make a day trade in here is just wasting money and energy, in my opinion. It doesn't make any sense, right? Because you won't get any decent moves. Joe is asking how much do you make a year trading? Well, I hope you don't expect to give you a euro or dollar value now, but I usually go for 25 to 35% a year. 25 to 35% profits a year from my starting account, whatever it is. And yeah, that's what I aim for. Some years get more, some years I get less. But I achieve that with very little risk, because I risk only about 1% per trade usually, or even less. And I don't spend a lot of time to get those. Yeah, last year it was like 37%, I think. I don't spend a lot of time to do that, just about an hour each day, which is for me personally, what I get, if you look at what I make per hour, is for me personally a very nice profit. So that's what I do. I probably could make more money if I would day trade more actively and sit on the screen all day and watch it, but that's just not what I'm looking for. That's not why I started trading. I actually started trading because I wanted to spend less time in front of the screen. So that's how I do it. Um, are divergences a real and good strategy? I personally don't believe in divergences because, they don't make a lot of sense to me, and it's just another way to overcomplicate trading, I think. To look for divergence in the trade. I don't know. The problem always is if you kind of like, let's say you get a nice trader strict entry setup on a Rothberg, right? And then you put in an indicator and it shows you divergence. And now what do? Now you don't take the trade because of that divergence. If you want, okay, but I'm going to take it anyway because statistically it's going to work quite nicely. Do you measure momentum of price action to improve the win probability of the trade? I'm not sure what you mean by momentum of price action. I definitely look for momentum. That's what trader strict entries are all about. Go with the momentum. And I also usually go with the ongoing trend. So I'm doing that, yes. Harry is asking where I'm located in Germany. Most of the time near Frankfurt, Heidelberg. And Wiki is just telling me I have to finish in 2 minutes. So I think it's time to wrap up. Do you consider fundamentals in your trading? No, I don't. Because each time I try to, I kind of like do worse than if I would not. Probably I just suck in fundamentals. So I'm better off not using them. If you're good in that, I think it can improve your trading, but to be honest, I'm not. So I kind of like avoid those and just trade what I see. So let me type in my email address for you if you have any questions or want to contact me. And you also might want to have a look at the website. And let's go to the last slide. Right, that URL you might want to write down too. That's where you can actually find free ebooks about the law of charts and the trader's rig entry for free. Everything's in there you need. They're very clear and nice, so you might want to get those. Next webinar, maybe I'll do one more in May, but doesn't look like I'll manage to do. Next one will be probably in June. If you got a suggestion for a topic, just send me an email, and I'll try to get that topic somehow. So thanks a lot for your time. Basic message of this one is keep your trading simple. Don't overcomplicate things. Don't try to avoid all losing trades and then to list them. Yeah. Happy trading and have a good time. See ya. I know I forgot the Terminator stuff. We'll do that next time. So bye.